So you're sitting there. It's 3 a.m. in the morning. You're refreshing your portfolio for the 17th time today. The number on the screen is fine. It's a little up from last month, a little down from last week. It's fine. It's always fine. You haven't been rugged. You haven't been liquidated. You're not some cautionary tale they tweet about. You're just stuck. Your portfolio has the ambition of a houseplant. And you feel tired. Wired, but tired. You want to know why? It's not because you're losing. It's because you're average. And in crypto, average isn't the safe middle ground. It's an active, expensive, full-time job that pays you less than a 19th century chimney sweep. We looked at the data, the on-chain fingerprints of thousands of wallets over 2 years, and the story they tell isn't about moonshots or catastrophes. It's about the slow, silent bleed of being perpetually, painfully median. You're not a degen, you're a ghost. And your portfolio is haunted by every decision you were too scared to make. My name is Sam, and I'm going to show you the precise, mathematical cost of your financial mediocrity. Let's define our subject, the average crypto trader. This isn't a profit and loss number. It's a behavioral fingerprint. From our data set of about 10,000 non-institutional wallets, we can paint the portrait. They make about 8 trades a month. Not enough to be a pro, not few enough to be an investor. Their portfolio holds 7, 8, 12 different tokens. None of them ever get above a 25% allocation because that would be risky, right? They're diversified. They're diligent. They're rebalancing. It feels like activity. It looks like strategy. Here's the data point that should make you throw up. 68% of these traders had monthly portfolio valuations that stayed within a plus or minus 15% band for 18 out of 24 months. In the most volatile asset class in human history, they achieved the stability of a sedated sloth. That's not safety. That's a cage. A very expensive, self-built cage with a treadmill inside. But you're not losing money, right? So what's the cost? Cool. Let's move from your portfolio to your psyche. This is pillar 2, the psychology tax. You pay the same entry fee as everyone else. The stress, the screen time, the anxiety every time you see a red candle. The doom scrolling when FUD hits. You pay for all of it, but you forfeit the payout. No outsized gains. No life-changing confidence. Just the grind. We correlated wallet activity with social data patterns. Wallets in this average cohort were 300% more likely to make a transaction within 1 hour of a major FOMO or FUD headline. They were 5 times more likely to sell a position at a 1 to 5% loss within a day of buying it. The just get out reflex. The data shows your stress isn't tied to losses. It's tied to uncertainty. The permanent, ambient state of the average trader. Now, let's put a dollar value on your exhaustion. This is a simple calculation even you can follow. Let's estimate your decision fatigue cost. Assume you have a $10,000 portfolio. You're the median trader, so your net gain for the year, after all that furious activity, is about 5%. That's $500. Great! Now, how many hours did you spend to earn that? 10 hours a week researching, worrying, watching charts, reading threads? That's 520 hours a year. Do the math. $500 divided by 520 hours. That's 96 cents an hour. You are paying yourself less than $1 an hour to subject yourself to modern financial anxiety. You are literally working a worse paying job than the one you're trying to escape. And you're the boss. You're a terrible boss. Burp. But the psychological tax is just the cover charge. The real financial massacre is happening backstage. Pillar 3, the math of missed opportunities, the ghost portfolio. Every average, middle-of-the-road decision you make actively murders a better version of your future. The cost isn't the 5% you didn't gain. It's the 100% you systematically avoided. Let's actually do the math on this. Take a real median wallet from our data. Starting capital. $10,000 over our 2-year window. After 2 years of buying dips, taking small profits, chasing narratives and diligent rebalancing. Net result, 11,200. A 12% gain. Pat yourself on the back. Now, let's create its ghost. The same 10 grand, placed into a simple, equally weighted basket of the top 10 cryptos by market cap at the start. No trading, no stress. Rebalance it once a quarter like a boring idiot. That ghost portfolio? 18,700. The cost of being average wasn't losing your 10 grand. It was missing out on $7,500. That's a 75% opportunity cost. You paid $7,500 for the privilege of feeling active and safe. You got scammed by your own brain. Here's where it gets even more pathetic. The dilution of wins. This is the part nobody in the 10 altcoins to buy now video will tell you. You are mathematically designing your portfolio to make winning irrelevant. Think about it. You have $10,000. You split it into 10 assets, 1,000 each. You're diversified. One of them does a 10x. A miracle! You now have 10,000 from that trade plus your other 9,000. Total 19,000. Your portfolio is up 90%. Fantastic. But here's the kicker. The average trader in our data holds an asset for 3 weeks. 3. What is the probability of a random altcoin doing a 10x within a specific 3-week window? Historically, it's below 1%. You have structured your entire strategy around a statistical miracle occurring on a timeline you invented. You've neutered your own success. You've built a portfolio where a 10x feels good but doesn't change your life. That's not investing, that's decorating. And the worst part? You think the solution is to be more right, to research harder, to find the next 10x faster, to make more trades. You're trying to outrun your own shadow. The data from the top performers, the actual top quartile wallets by growth, tells a completely different story. Pillar 4, escaping the median. Their secret isn't accuracy. It's asymmetry. Listen closely, because this flips everything. The wallets that outperformed everyone didn't have a better win rate. They had a higher percentage of losing trades. 58% of their trades closed at a loss, compared to 49% for the median trader. They were wrong more often, but their average winning trade was 4.7 times the size of their average loss. They held assets for a median of 11.2 months, not 3 weeks, 11 months. They weren't trading, they were waiting. The path forward isn't about being more right. It's about being differently wrong. You accept a bunch of small, planned, inconsequential failures to fund the search for the one rare, enormous win. Your goal shifts from how do I avoid being wrong to how do I structure my decisions so that being wrong doesn't matter and being right changes everything. Let me show you the magic number the data spat out. It wasn't about profit percentage, it was about concentration. In the top performers, 50% or more of their portfolio was in their top 1 or 2 conviction plays about 65% of the time. They weren't diversified, they were convicted. The median trader's top holding was usually under 20%. They were playing not to lose. The winners were playing a different game entirely. Now let's meet 2 people. First, Maya. Maya is 32, a project manager. She's not a gambler. She does her research, reads Twitter threads, watches a few videos. Every month, she takes $500 of her DCA and puts it into a new promising project. Her portfolio has 14 assets. She checks it daily. When one is up 30%, she takes profit to be safe. When one is down 20, she averages down because the fundamentals are strong. Her portfolio chart for 2 years looks like a flat EKG, a heartbeat with no blood. She's put in $20,000 over 2 years. It's now worth $22,000. She wonders why she's so tired all the time. Maya is paying the full invisible cost, the stress wage, the ghost portfolio. She is the median. Now Ben. Ben is 41. He was Maya for 3 years. Then he had an aha moment after a tax nightmare from 200 plus trades. He now runs 2 wallets. One wallet is 80% Bitcoin and Ethereum. The Sleep at Night Fund. Boring. Slow. He doesn't touch it. The other wallet is 20% for what he calls asymmetric bets. He makes maybe 2, 3 trades a year total. He only acts when he has a conviction so strong it makes him physically nervous. Last year, he missed 10 hot coins. He watched his boring BTC and ETH chunk only go up 50%, but his one asymmetric bet did a 12x. He's less stressed. He spends 90% less time on crypto Twitter. And his portfolio growth has accelerated. He escaped the median. He stopped paying the tax. So here's the forbidden knowledge, the summary you can scribble on a napkin. In a hyper-asymmetric market like crypto, there is no neutral ground. Playing it safe by diversifying into mediocrity and trading frequently is not the middle point between winning and losing. It's a distinct third category with its own punishing physics. It's the financial equivalent of running on a treadmill that's also on a slight incline. You're working hard just to simulate standing still. The invisible cost has 3 line items. First, the psychological tax, paying yourself less than $1 an hour for your stress. Second, the opportunity cost, the ghost portfolio of gains you systematically murder with your average decisions. And third, the cost of time, the thousands of hours you pour into an activity designed to keep you exactly where you are. The prison of the average trader has an open door. It's not marked better research or more signals. It's marked conviction. It requires a brutal portfolio surgery. Carve out a large, boring core position you don't touch. This is your foundation. It removes the desperation. Then, with a small portion, you hunt for asymmetry. You make fewer decisions. You let them be bigger. You accept that most will fail. You structure them so the failures don't matter. You wait for the one that does. You stop trying to be right all the time. You start trying to be right in a way that actually matters. The data is clear. The math is unforgiving. The choice is yours. You can keep running on the treadmill, watching the ghost of your potential portfolio mock you from the sidelines. Or you can step off, build a chair, and wait for the right moment to actually move. Burp. Now get out of here. I'm tired of looking at your on-chain history. It's depressing.